We are watching a $5 trillion financial pipeline form in real time. Artificial intelligence isn't just changing apps. It's restructuring energy grids, mineral supply chains, digital payment systems, and global power. China tightened control over critical mineral exports at the start of the year, and Washington is racing to pass digital asset regulations. Banks are debating whether stablecoins should be allowed to pay interest, because deposits are the lifeblood of the banking system, and trillions of dollars are quietly repositioning. And most people see AI as software, but underneath it, a new financial architecture is forming. And this channel focuses on systems because when you follow capital flows, you understand where leverage is moving. In the last video, we broke down AI as infrastructure. Today, we go deeper. Let's follow the money. AI isn't just innovation. It's industrial deployment of capital, and trillions are being allocated to data centers, semiconductor fabrication, power generation, transmission lines, cooling systems, automation. Every infrastructure cycle reshapes capital flows for decades. The railroads did, oil did, telecommunication did, the internet did. AI is next, but every layer, energy, chips, compute, depends on something deeper: financing, debt markets, private credit, infrastructure funds, sovereign wealth capital. AI is not just a tech story, it's a balance sheet story. AI is not virtual. It runs on electricity. It's built with steel and concrete. It depends on high voltage transformers. It consumes water for cooling, and it's financed with debt. And some analysts estimate over $5 trillion will be required to sustain the next phase of AI expansion. And utilities are revising demand forecasts. Private credit markets are funding data centers at record levels. This isn't just innovation. This is industrial build-out. And at the bottom of the AI stack is energy. AI systems don't sleep. They train on massive data sets, and once deployed, they operate in real time, non-stop. Every search, every recommendation, every automated decision, all of it requires electricity. The power demand is enormous. So utilities are seeing load growth they haven't seen in decades. Grids are expanding. New generation is being approved. Even nuclear is back in discussion. AI isn't just a software revolution, it's an energy acceleration. And so when you look beneath the energy layer and beneath the chip layer or materials, and China controls over 90% of rare earth processing, around 98% of gallium, and roughly 60% of germanium. So these materials are essential for AI chips, advanced electronics, data centers, and defense systems. And at the start of this year, China tightened restrictions on certain critical exports. This wasn't symbolic. This was leverage. Now, on January 14, 2026, Trump signed a presidential proclamation 11001 and stated, "Processed critical minerals are essential to U.S. national security." Silver was added to the U.S. critical minerals list. Silver isn't just monetary, it's industrial. High conductivity circuits, semiconductor applications, data center infrastructure. AI expansion increases industrial silver demand. Materials are strategic assets. Now we move to the financial layer. Stablecoins processed over 33 trillion in transactions last year.
Latest data were that $33 trillion worth of transactions in stablecoin last year. That was a 72% increase on the year before.
More than Visa, more than MasterCard, and PayPal combined.
Taking out your Visa card or firing up a bank wire, or it's just completely absurd. And so we need a medium of exchange that can scale down to fractions of a cent, that has the money velocity and speed of the internet, that works openly, globally, interoperably. Any software or hardware connected device in the world that may have AI, agentic activity happening on it, being able to transact.
AI systems transact machine to machine. So they need programmable money, instant settlement, global reach, low friction. Stablecoins are emerging as digital settlement rails. Traditional banks are watching closely, and some policymakers are debating whether stablecoin providers should be allowed to offer yield. The banks argue that yield-bearing stablecoins could possibly pull deposits out of the banking system. So they're trying to protect the legacy system. And supporters argue it creates competition and innovation. This debate is not just about crypto. It's about who controls deposits in the future. And lawmakers openly admit they're under pressure to define digital asset rules. Clarity determines capital flows. Institutional money waits for defined frameworks. Pension funds, insurance companies, asset managers, they move when risk is defined. Regulation is not a side story. It determines where the next $1 trillion flows. So if we step back, energy powers computation, and materials enable production. Chips drive intelligence. Cloud delivers scale. Models create compatibility. An application generates value. Digital financial systems move capital through it all. And this is not one industry. It's a structural reorganization of infrastructure and finance and geopolitical leverage. This channel focuses on systems because systems determine incentives. Incentives determine capital flows, and capital flows determine outcomes. If you want to understand the future, don't chase the noise. Study structure, study leverage points, study the flow of money. Follow the infrastructure, follow the materials, follow the incentives, follow the money. Because when you follow the money, the story changes. If this helped you see the system clearly, subscribe. We're building this layer by layer.